For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and health care? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. We are managing your financial future. That's what we do. And we do it with gusto. We do it with verve. We do it with Professor Rick Plum, CFP professional, certified financial planner, our advisor. Hi, Rick.
Good morning, afternoon, evening.
Wherever you happen to be, in all the ships at sea or whatever that old saying was. Happy to talk today about something that I love it when we get a chance to, I don't want to say debunk, but I love it when we get a chance to go against some of the conventional wisdom.
Or clear up some of the misinformation.
Clear up confusion. This is what we're going to do on this particular episode here. To me, retirement is all about having some form of security. I'm speaking personally, okay? I love guarantees. I love sure things. And I've said this many times. I love to know what's the worst possible situation. What's the worst possible what's the worst that can happen?
What's the worst outcome?
Right. Give me the worst outcome. I will prepare for that. And if I know the worst is the outcome, I'm all right.
Plan for the worst. Pray for the best, but plan for the worst.
Yeah, plan for the worst and maybe work toward the best. This has to do with protected income, I'm going to call this. We've known it as guaranteed income. We've, pensionized income, if you want to look at it that way. Lifetime income. And how it may actually work to enhance your retirement and how it's going to work, how you make it work, Professor Plum, in a bucket strategy. Now, the word annuity has a bad rap.
Oh, very much. People turn off, right, when you say that
they
word.
tend to. And if you've never heard of one, you might not. But if you've looked around, some of the big name advisory firms really badmouth these things. Uh-huh. And I would say for reasons that are half correct and reasons that are half incorrect. What do you say?
You were saying, they have a bad rap. It's like sometimes deservedly so. Sometimes definitely the critique is way off base.
And it has nothing to do with the annuities themselves.
Oh, no, there's some bad ones out there.
Well, no, that's true. That's true. Okay, I shouldn't. And the zoomed out vision of this, right. The idea of an annuity. Let's use the tool analogy.
Well, one of the first problems is that just saying annuities are bad is very broad brushing it, because there are lots of different types of annuities. They cover the gamut from growth to safety with the bells and whistles, and you can't say everything is bad.
No, yeah,
because that's just too general. There are some bad ones, and there are within individual types of annuities, but there's lots of different types of annuities. There's the immediate annuity, which is a stream of payments. There's no cash value to it. You put your cash in, you get a stream of payments for a specific period of time, or potentially an open-ended period of time like the rest of your life. There are deferred annuities, and the deferred annuities are the ones that get the big bad names because there's a lot of different types. There's fixed annuities with no fees. There's fixed index annuities. Most don't have any fees. There's structured capital type annuities. Most don't. Some do have fees. And there's variable annuities, and variable annuities have the fees. Mm-hmm. And so when they say all annuities are bad because the fees are just too high, well, that's only one portion of the world. And then you have to compare, okay, what am I getting, if anything, for that fee, that internal fee that I'm paying? Sometimes it's worth the price, sometimes it's not.
Now,
so it's a matter of looking at it.
Yeah, and we won't get into every type of annuity that you mentioned here, but you just understand that there are different types out there. The one type that I want to talk about here is one that I believe certain people can find useful. In fact, they can be helpful. And I think I mentioned the word enhance your retirement. In many ways they can. What type are we talking about here?
Well,
Professor
what you're
Plum?
alluding to is something that is a guaranteed income for a period of years, or for most of the time that we do it this way, for the rest of your life. You give the insurance company X amount of dollars, and they promise to pay you some monthly amount, annual, semi-annual, however you want to set it up, for as long as you're alive. And there's different ways to do it, but the most popular way now is with these, protected income, lifetime income annuities, where you're using your own money for the first several years. But if you live a long time, now, if you don't live a long time, the problem, let's step back. Prior to the lifetime protected income annuities, the only way to get a guarantee of income was to give the insurance company a boatload of money or a big chunk of money, and then they give you a promise to pay you a monthly income for the rest of your life. But what happens if you died next week by the proverbial Mack truck? Well, in many cases, the insurance company kept that lump sum. 10, 20 years ago, they started coming out with other ones. So they took a deferred annuity and said, well, we're going to use your money for the first X number of years, and if you run out of money, we'll continue to pay you the income for as long as you live. So if you get hit by the Mack truck and you haven't used all your money, we'll give your heirs the rest of the money. But if you live to be 127, we'll keep paying you for as long as you're alive.
Yeah.
And so that way you didn't have to worry about what if I get killed, die too soon.
Yeah, it becomes less of a gamble.
It had a little bit of different tax treatment for the recipient of the income.
Okay.
But that's a whole
so in
complicated
general
area. But it's an idea. It's how do I get something that will guarantee, if I don't have a pension and I like having guaranteed money, I like getting that paycheck every month. When I get my paycheck, I feel better because I know I can make my bills going forward. How do I recreate that when I'm not working?
Well, that's it. If I took, I'm going to make up an example, $100,000, and I want to take $6,000, $7,000 a year, something like from that. It might last me, depending on how much I can earn. If I took $7,000 a year, it might last me.
The statistics show that with a 6 or 7% distribution rate, and that's what you just described.
What it is, yeah. You've
probably got a 70 or 80% chance of success, but that's a 20 or 30% chance of failure if you live 30 years. I don't have the exact numbers, but the higher over 4%, the lower the probability that it'll last for 30 years.
I could run out of money, is what you're saying.
There's a chance you could run out of money, or there's a chance more likely that you would feel worried about running out of money and change your lifestyle.
Yeah, that's what would happen
too.
So by handing it over to a company that says, "Hey,
I guarantee I'll pay you this."
Right. So even if you happen to run out of all the $100,000,
if the cash value runs out, you still have an income for the rest of your life.
And if you live to be 120, well, we made as the insurance company made a bad deal, but it's good for you.
Right.
Yeah. That's kind of the wager you're making.
Right. And that's what we try to accomplish. Live a long time for a lot of reasons. But one is to get more money out of the insurance company. So,
I'm going to just bring up some research on this. I don't like to coat people with research because it's just, but to kind of help the cause a little bit, I know that two researchers with Principal Financial Group, Dr. Michael Finke, I'm told it's pronounced Finke.
Not Fink, but Finke.
CFP professional, and Wade Pfau, PhD, CFP
both very well known
yes.
For their analytics in the financial planning world.
Right. They're researchers from the American College. Now, they studied all this stuff. They're very well respected within the advisor community. They did some research on this. Now, you just comment on these as I bring this up, okay? I want to spend a ton of time on it, but what they found was that these types of income annuities, where you're getting income for life, allow a retiree to spend at a level that just investments alone would be unable to match without significant risk of running out of money before age 95. It's exactly what we just said.
Right. So we were talking about the odds of running out of money for over a 30-year period of time. Once you get over 4.5%, the odds start coming down. How far the odds come down? How far above 4% are you going to go? You get into the 8, 9, 10%. You get some bad odds there for you. But having some form of a guaranteed income, and guaranteed income comes in many forms, and so this is just one way to get the amount of guaranteed income that you need.
It takes that risk off the table.
Well, and it takes the risk off the table, but it also does something from a psychological standpoint. One of the biggest threats to an individual's portfolio isn't the market, because we know what we're expecting with the market. It's going to be volatile. The biggest risk is the emotional reaction to what the market does to us. And we saw this in 2000. We saw this in 2008. We saw this in large downturns that don't recover like 2020 did, within about a week and a half. When the markets go down and you're drawing an income from it and it stays down for more than a couple of weeks, people tend to get emotional about, oh no, it's never going to come back. I have to sell out what I have left in the market so that I don't lose it all. And unfortunately, that is going to hurt in many cases, because by the time people finally get around to selling, it's probably pretty close to the bottom of the market. By having income from a source that can't change, pension, Social Security, protected income. I'm not as worried about the market going down because I don't need that income to pay my mortgage, my rent, my whatever my bills are. I've got my income covered. I'm a more rational investor for the rest of my portfolio. So yeah, it does allow people to do things, and it allows for a better legacy in many cases.
Well, it does. The other part of the research says that adding an income annuity to a retirement portfolio allows a retiree to get the same or higher income with lower risk of outliving savings than an investments-only approach. Well, that sort of is what we said before. Using both annuities and investments, they found, combining them can enhance the value of assets for heirs, as you just said, over the long term.
Long term is a key here, because it's a matter of the emotion, and this has to do with the emotional aspect of it. When we have all of our income covered, we've got our basic income covered, and we've got enough to pay for food, gas, water, electricity, insurance, as I mentioned, rent, things, the basics, everything that we have to pay. When we got that all covered, we're less emotional about the rest of the money. And because we're less emotional, we don't react emotionally as much as we would otherwise act, which allows the money to recover instead of being sold off and put in cash. And when it recovers, that's more for the heirs.
Well, yeah, I think what you're saying is that when you have some protected income that you can't outlive, that you can kind of play offense, as we sometimes say, with some other part of your money where it doesn't have to sit in cash. Maybe you can invest it for growth potentially, more to equities anyway than you otherwise would if you were worried that you were going to need it at some point soon.
Right, and so it allows you to be more aggressive, and as the emotions come in, stay more aggressive with the assets you don't need to spend tomorrow, because you don't need to spend them tomorrow because you got your guaranteed income.
Now, one other thing here,
key thing, the guarantee is coming from the insurance company or whoever's providing the guarantee.
It's not coming
from me.
No. It is the full faith and credit of the insurance. No, the claims paying ability of the insurance company. We should throw that in. It's probably going to be in that long disclosure that's at the
I know,
end.
but it's important.
It is important. You need to know that. Don't go to
Shifting Sands of Iowa life insurance company for
Is it Iowa? We always make it. Idaho.
The problem is it keeps moving states, and we never know where to find it.
Now, here's one other thing. Interest rates. Of course, they've come up over the last couple of years.
Right.
Now, before, it was very tough to get you don't buy these generally for the interest rate. But, Professor Plum, now that interest rates have come up, some of these annuity carriers have gotten a little bit more creative with some of the things they're offering. Right?
Well, anytime you have something that's making a payout, interest rates become involved. It's behind the scenes as much as anything else, because the insurance company that's providing you the guaranteed protected income, they can earn more on their cash, on their investment portfolio. And because they can earn more on their investment portfolio, they can pay more to the individual contract holders going forward. When interest rates were 0.0 nothing, insurance companies didn't have the leeway to, they weren't earning as much. And because they weren't earning as much, they couldn't pay you as much. Now that interest rates have come back a little bit, and they can then ladder out bonds, they can do things that will structure it out so they can pay more on their portfolio, because they're earning more on their house portfolio. They can pay more to you, and they are.
Yeah. Now, I should also mention that you said interest rates. Now, they were low for a decade and a half,
a long time,
and they've been coming down. Obviously, almost they went down for a better part of 35 years.
Well, yeah,
40 years
on a downward trajectory.
Right. It
was from 1980 till
I was
2 years ago.
Yeah, something like that, sometime in the 1980s. So if you've already got one of these, just as a side note, there's a chance that there's a newer one now available that might have a more favorable rate. So even if you've had one of these for a while, potentially.
And they're always trying to redesign them and make them better than the guy next door, because insurance company A wants the business, and if insurance company B is offering X, they're going to offer X plus 0.01 more.
You know what I find interesting here? The research that Dr. Finke and Dr. Wade Pfau came up with said that using both annuities, I mentioned this before, and investments can enhance the value of assets for heirs, and I suppose for yourself as well. That sounds to me like a bucket strategy.
Well, the whole idea is to make the income last for your life, and if possible, leave, as most people want to leave, some legacy, and as much legacy as possible to their heirs if they have heirs.
So what's the basic tenet of the bucket strategy, Professor Plum? Just in its most basic form, what is it designed to do?
Stable cash flow for the rest of your life.
Yes.
And hopefully leave something left over.
That sounds to me like this is something that these types of products for people who need them.
And they are tools that we do use.
Yes.
When appropriate. Now, not everybody should have a protected income product because not everybody needs a protected income. I was speaking with some people earlier today, between their Social Security and their pensions, they've got about, $9,000 a month coming in. Their expenses are about $6,500 a month. They don't need any more protected income. So they don't need to set aside any money in something that they've already got their protected income from other sources. Not everybody, and I would say probably a majority of people, do not have enough income coming in from protected sources to cover their needs. And so if you have income needs that are higher than what your protected incomes are, protected income being Social Security, pensions,
right,
and things of that nature, you might want to look at this type of contract to bring you up to that level so that, and there's different types of spending. There's the spending we got to do, the spending that we have when we wake up in the morning. Whether we wake up in the morning, we have expenses through the month. We have mortgage or rent, we have property tax, we have basic insurance, food and gas, electric, all those things that doesn't even entail us having any fun yet. But we want to have enough income from protected sources to cover all of those expense categories. How much we travel, that can be a little variable. This year I didn't feel very good. I didn't travel as much. Next year I'm feeling, maybe I'll feel a lot better and I'll travel more. So the travel budget's a little variable, but the protected income side of it, you want to have enough coming in to cover all those fixed expenses.
Those short-term expenses should be covered by some type of guaranteed income.
And those expenses are going to continue for the rest of your life in many cases.
In one form or another.
We want to cover that with protected income. Not everybody has enough Social Security. I was speaking to somebody else. Their needs are about $6,000 a month too, but between the two Social Securities, they don't have any pensions. They've only got about $5,000 a month in Social Security, and so they need another $1,000 a month of protected income to get them to the level to cover their expenses.
Now, somebody, an astute observer, might say, "Okay, look at this now. I understand how buckets work. Okay, you've got a cash flow bucket, your short-term bucket one, right?
Correct.
This provides you with the cash flow that you need." In a way, it's kind of protected income, just based on where your...
But bucket number one is not lifetime.
No, it isn't. I want you to explain this for just a second. But somebody who looks at this says, well, okay, so a bucket one is going to give me some cash flow. It's supposed to be, safe, non-volatile assets, allowing bucket two to the time it needs and bucket three the time it needs. So what you guys are telling me on this podcast is that there is potentially a fourth bucket for something called protected or guaranteed lifetime income. So I want to know, how is this different? How is protected income different from what I might get in my bucket one as a bucket strategy?
Well, bucket number one is a stable cash flow, but it's for a fixed period of time, 6-7 years or something, depending upon the aggressive or conservative nature of the underlying investor. It's not a lifetime issue. We do add this fourth bucket to people who need it. Not everybody needs it. That's why it's not part of the core buckets. The core is bucket number one, that's going to last for 6 or 7 years. Bucket number two, that's not going to take any distributions for 6 or 7 years, but refill bucket number one 6 or 7 years from now. So we want to make sure it's available, and it doesn't drop the day before we need it. And then by doing the first bucket and second bucket, that means I have 12 to 15 years that I can put the rest of the money into growth and not worry about what happens tomorrow in the market. And so that goes up and down, but over 15 years, that we have a very high confidence that we're going to do a decent rate of return on that, which replaces what we've been paying out of bucket one and ultimately bucket number two, and growing the overall portfolio over time.
But you're not just buying 30 years, are you, with a bucket strategy?
Well, that's the bucket in that respect. And one of the things people will ask is, why did you only do 15 years? Well, because over 15 years, we have a good idea. What are you taking out in year 15? If you're taking out 40% of the portfolio in year 15, this bucket strategy is not going to work for you. But if you're taking out 5 or 6 or even 7% when you're in your late 70s, early 80s, that's okay. The bucket strategy is working. Now, on the other side, we buy the lifetime income. even though we can make it work with a true buckets, a core,
Sure.
a
Yeah.
3 core buckets, but we're always trying to combat that emotional aspect of it. And in many cases, controlling the emotional reaction to the markets is one of the primary concerns that people have. And so we use these products to buy that stability type thing, so that people don't, even though, yes, they know they've got buckets set up, they know they don't need that bucket number 3 for 10 to 15 more years, yet the market goes down like it did in 2008. It's still an emotional time. And if you can't hold the course, stay the course, maybe you need to have something else to give you some more emotional stability, to let the things work for you the way they're designed to work.
What a great point. And this is why some people need it, others don't. They could just use their regular bucket strategy.
Oh, yes.
And they'll be fine. This is sort of a fourth bucket is just another, maybe a hybrid, if you want to call it that, an offshoot that will give you some extra stability if you need it.
Right. And so there's a difference there's needs, and some people don't necessarily need it, but they know that they are skittish. They know that they are reactionary. And so they'll add some of it, even though they don't need it. They want it, and it makes them feel better. Fine. That's it. Good. It'll help them out. And there are people that can see that they might need it, but they say, they're more aggressive, and they just they don't feel like they need the guarantee. So that's your call. But we're going to talk to you about it. If we feel that you should consider it, we're going to talk to you about, here are your expenses. Here's what you're trying to accomplish. Here's the way to do it. Now, there are ways to use the lifetime income annuities to help lessen the risk on the overall portfolio. So take our proverbial, $40,000, $1 million portfolio that's providing $40,000.
Mm-hmm.
And if we can get a lifetime income that pays us 6%, so we take $200,000 and we're getting $12,000 guaranteed. Now I only need to get $28,000 out of the remaining $800,000. I don't have my calculator in front of me, but that's less than a 4% distribution. So I've lessened the distribution rate on the remaining 800,000, and because it's a lower distribution rate, it has a much higher confidence of growing over time.
Or it may potentially grow, may potentially, as a result, last longer. And you got to buy time. I mean, really, does it come down to just buying time?
That's what we're trying to do. We're always looking to buy time to let the markets. People are talking about the volatility of the market. The markets are always volatile. I mean, we've never had all through the years I've been doing this, which is, more than 30 now.
Yeah.
People have talked about volatility. It's new. It's different. It's volatile. That's not new and different. It's always been volatile. The thing triggering it may be something new that we hadn't thought of before, but it's always volatile.
Of course.
And can you control that volatility? Nope. You have no control over it. What you have control over is your reactions and how you use that volatility to your advantage, or how you protect against it. By doing a buckets plan, you're doing both of those things. You're trying to protect against the volatility of a down market by having enough safe money to spend over the period of time, 6-7 years in bucket number 1. But we're also using that volatility to your advantage by leaving money alone for 10-15 years to grow and outpace the inflation that the market tends to give us. And so that's what we're trying to do with buckets.
Some people have said, gee, though, you're going to safen up a portion of the portfolio. Doesn't that take away from the rate of return? I mean, aren't I sacrificing? I mean, my gosh, if you're gonna safen up half or more of my portfolio, and I use that term loosely, safen, doesn't that hurt my rate of return? Why would I do that?
Well, rate of return,
he said in his best leading question voice.
Rate of return is an interesting concept. Rate of return for a buy and hold is one thing. And if I have an investment and it's up and down all over the place, but over a 10, 15 year period of time, it earns 4%. It's a 4% return, 8% return, 10, whatever the number is.
Yeah.
How I got there isn't that important. Whether it went up 20% a year for the first couple of years and then went down at the end and it equaled out to be an 8% average rate of return over the 15 years, or whether it went down for a couple of years and then came up at the latter part and it totaled out to be, and my ending point was the same place, it doesn't really matter. But something strange happened on the way to the,
Yeah.
if I'm adding money to it or taking money away from it, that rate of return, that static average rate of return changes dramatically. Because if I'm adding to it, having negative numbers in the early years actually, and then positive numbers in the later, still with the same portfolio we had before, gives me a better option than having great returns in the early years and lesser returns later. But when we're taking money out of the portfolio,
exact opposite.
When you have negative returns in the early years, first 10 years, and then great returns at the latter part of the time, that's going to be detrimental, because by the time you get to the greater returns, you don't have as much money there.
That's true.
We've done this before. We've talked about the
sequence of returns.
Sequence of returns is huge. And so all returns are not created equally. And so managing how you're taking distributions from a portfolio, you never want to be taking cash flow out of portfolio where you have to sell something that's in a down position, a down market.
Yeah.
You want to avoid that at all costs. We've talked about it before. There was a study by John Hancock years ago. Somebody retiring in 1969, somebody retiring in 1979.
Did the whole sequence of returns.
They did a balanced portfolio in both, and one of them was out of money in 20 years. The other one had boatloads of money after 20 years, whatever. And then all I did was I took it and said, let's take that balanced portfolio and make it safer.
You mean like a bucket strategy?
A very simplified bucket.
I think you did a 2-bucket.
Yeah, I did a 2-bucket. I just took half of the money and put it into a mattress, earning absolutely nothing, losing nothing, but earning nothing.
And taking the money from that mattress.
And taking the 5% distribution, no COLA, for the 10 years, replenishing it after 10. And in both cases, in the case where the person went out of money after 20 years, they had equal to or greater than their starting point 20 years later. So they were doing better. Even though you would consider to being half of the money earning nothing, a more conservative position. Conservative won the race there. So what's it going to cost on the upside? And we did the same thing for the person that retired in 1979. And after 30 years... You
really weren't missing out much.
If you just did the balanced portfolio approach that they used to begin with, after 30 years, there was almost $600,000 in the portfolio. And using the quote-unquote more conservative portfolio...
Safer, yeah.
Putting $50,000 in the mattress and pulling $5,000 a year for 10 years, you had $500,000 left over.
I don't even think there was a full $100,000 difference.
That was like 503 versus 597, but
it was.
But it was
really
round,
close.
It was close. So you did give something up on the upside. But can you tell me that the next 10 years are going to be good years or bad years?
No, and in fact,
are you a good year or a bad year?
And I'll tell you what, I am. To me, it's worth that.
Right. Would you give up the difference between 500 and 600,000 30 years later to make sure you weren't broke in 20 years?
I don't know that I could. I said at the top of this podcast, that I'd like to know what the worst possible scenario is. But if all I'm going to do is rely on stock market, I don't know I'll never know what the worst possible scenario is. Worst, I guess, is that I'm completely out of money.
That's a problem.
It is a problem. I don't want that.
Right. And the legacy is one thing. Having the portfolio grow, if I'm starting at 65 and, maybe I'm not looking to leave the kids gazillionaires when I'm 85. But if I can have a larger potential legacy, that also means I have a larger potential long-term care bucket, a potential medical bucket that pay for my own expenses when I get into my late 80s and 90s, where the medical expenses tend to really kind of pick up.
So, Professor Plum, the idea of lifetime income using, yes, the A word, annuities, can be, for the right candidate, can be a wonderful addition to not just to their portfolio, but to their bucket strategy.
Yes, you always have to look at it in context of what's your strategy. How does this enhance what I'm trying to accomplish?
Yes.
If it doesn't enhance what I'm trying to accomplish, why am I doing it? And in many cases, for the right person, that protected income helps them, this is the right strategy.
And this is why you integrate your investment strategy with your portfolio withdrawal strategy. It's absolutely essential. All right. And here's why. Your investment strategy can dictate how your money is spread out in different types of investments, which of course affects how much your portfolio can potentially grow and the amount of risk it has. But the way you withdraw money from your investments, the method, that has a huge impact on how long your money lasts, especially if the market is down, as Professor Plum just said. When you set yourself up with the Lucia Capital Group bucket strategy, you know that during times of market volatility, your cash flow will not be affected. You don't have to take less money simply because the stock market might be going down. And I think that's what retirement is really all about, isn't it? Stable cash flow, growth potential together. That's what you get when you invest with Lucia Capital Group. By the way, give them a call, 800-644-1150. Find out what a Lucia Capital Group bucket strategy may be able to do for you. 800-644-1150. They've been a long-time sponsor of this program, and we do appreciate all that they have done. Professor Plum, thank you.
Welcome.
As always, I appreciate it. We've been working together so long that I know if I ask you a question, I know right where you're going. I don't have to wonder. But
then why do I have to come down here and do this? I'm kidding.
Well, I mean, consistency. I mean, go back and listen to the advice that we were giving on the radio all those years ago. There's no difference. I mean, nothing has changed. It's not like the kind of advice that people used to give way back in the 90s. They'd say, well, you need to buy this particular stock. Here's that stock XYZ. And then they come back a year later. Well, now that's no good anymore. We're going to buy this. And this is. They keep changing strategies based on the changing winds of the markets and the environment and all that stuff. Ours has stayed absolutely stable. Talk about stability.
But it is individualized. I remember listening to somebody in the late 80s, early 90s, and their advice to everybody was put 50% in this growth fund and 50% in this bond fund. And it was the same advice regardless of whether the person was 20 years old or 80 years old. And it didn't matter that the fund that they were recommending was the only fund that paid trail commissions on everything.
Well, there's the idea of a bucket strategy, and then there's the bucket strategy. And this one is this is why we talk about it.
Has to be tailored to you. Yeah. As we talked about with the protected income, as beneficial it is for some people, it's not beneficial for everybody. Who are you? Is it beneficial for you or not? Should you be looking at this? Talk to an advisor to see whether or not it makes sense for you to add this to your portfolio. This is part of a bucket strategy. In many cases, or some cases, it's nothing. You don't put anything in it because you don't need it. In other cases, it's a larger percentage of the portfolio. It's never going to be 100% of the portfolio.
No, it's not.
But it is part of a bucket strategy.
Talk to a Lucia Capital Group advisor, because that is where you're going to get the bucket strategy. 800-644-1150, 800-644-1150. Go online, too. Find us at luciacap.com, LUCIACAP.com. Lots of articles, videos, and you can find our podcast there. I believe you can find past episodes of our podcast. You can certainly subscribe. Go to Apple Podcasts or Spotify. Download every single week. You get these updated episodes, and you don't want to miss a single thing, because I tell you what, this is wonderful information. If you become a regular listener, I can almost guarantee you're going to be a smarter financial person just for having learned all this stuff.
You'll learn something.
I 100% believe it. I'm living proof of that. Professor Plum, again, thank you so much.
You're welcome.
We'll have you back next week. For Professor Plum, CFP professional, certified financial planner, I am your podcast host, Johnny Dean. Talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to buy or sell any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Variable annuities are long-term investment products designed for retirement purposes. Variable annuities with guarantees are available through optional riders at additional cost. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties, and if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Before investing, carefully consider a variable annuity's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Variable annuities with guarantees are available through optional riders at additional cost. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. It is important to keep in mind that investments in fixed income products are subject to liquidity risk, interest rate risk, financial risk, inflation risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.